If your portfolio consists of only high growth tech stocks, the past couple weeks have probably been pretty rough. Now in this video, I want to talk about diversification, and it's mostly geared towards beginner investors just to get you familiar with diversification as a whole and how you can use it as a risk management tool. From a high-level view of diversification when it comes to finances, you may have money across stocks, commodities, bonds, cash, cryptocurrency, all these different asset classes. But in this video, we're going to be talking about specifically stocks, and it really works for any of these asset classes, but if you dig into one specific area, you also can have diversification within that asset class. Going further, this image does a good job to explain diversification. So we talked about how you can have different asset classes, but within that asset class, let's say for instance stocks, you may have a company like Facebook and a company like Google. Now these are both the individual companies, but if you go to the industry level, they're both within tech. So let's say instead of Google, you have ExxonMobil. That's a different industry, and now you're exposed to different factors that may impact that stock and its performance. And then another factor is geographical dimensions. So, you can invest in the US, or maybe you can invest in companies in Asia. Now, it's also important to understand the connection between risk and diversification, because if you want to get filthy rich within a short period of time, it doesn't make sense to diversify, right? But at the same time, you're taking more risk. So for example, let's say you have stock X and you put all of your money into stock X. Turns out that's Amazon and you absolutely made a killing. Or stock X turns out to be Enron and you lose everything. It's a high risk play because you're putting all of your eggs in one basket. So by diversifying, if let's say you buy 10 different companies and one goes bankrupt, you don't lose all of the money that you invested. Essentially, that's all diversification is. And as you diversify across even more assets, you're probably going to get closer to an average return, which isn't necessarily a bad thing. With that being said, it's important to understand what your risk tolerance is and what your goals are with your finances. So Vanguard has an investor questionnaire, which is pretty great, where you can answer these quick 11 questions, and it basically tells you how risky of an investor you are and kind of your goals and timeline to get there. For me, there's kind of three buckets that you may fit in. The first being a low risk passive investor where you want a lot of diversification and you just want exposure to the market over a long period of time, and you're happy with average returns. For investors that fall under that category, it makes a lot of sense to buy something like an index ETF or fund, where it tracks the performance of the S&P 500, the NASDAQ, any index which is composed of different companies. So you buying this ticker symbol, SPY, you get exposure to a ton of different companies. You can see here the top holdings within that fund. You get companies like Apple, Microsoft, Amazon, Facebook. These companies have a higher weighting within that index, and when you buy it, you get that exposure to 500 different companies. Now, taking this even further, you have the sector weighting. So we just looked at a lot of tech-related companies. Within the S&P 500, you can see 24% of the companies are tech-related, whereas 13% are healthcare-related. So if you own the S&P 500 and the tech sector is getting absolutely destroyed, that's okay because you have the energy sector, you have the financial services sector, and if those are doing well, you're not as exposed to the downside of only one sector. So that's where the diversification can help you a ton. Then you have a second group, which I consider I'm part of, which would be medium risk, as well as you want to diversify, but you're not going all in to like 3 or 4 companies. If we look at my public portfolio or the Patreon portfolio that I share on TikTok and Instagram, you can see that technology is around 50% of my portfolio. So compared to the S&P 500, I'm more weighted into technology companies, and I have less diversification versus the S&P 500, but I have a higher conviction in the companies that I'm selecting within my personal portfolio. If we go back to the S&P 500 breakdown, you can see Tesla is around 1.6% of that portfolio. If I personally think Tesla is overvalued and don't want to own that within the index itself, Well, I kind of create my own index or my own portfolio where Tesla isn't part of it. So if Tesla is going down relative to the overall market, I'm not getting dragged down with the poor performance of Tesla. Now, that's just one example. Let's say you are that third category, the high risk taker, or the one that isn't diversifying. Let's take a look at that. Maybe you think Tesla is the greatest company ever and you want to invest in it no matter what. So if you invested at the beginning of March, you obviously made a killing. And if it was the only stock in your portfolio, that's great, because if you diversified, you would have had a smaller return. Now, let's say you started investing all into Tesla right around the beginning of the year. If you compare that versus the S&P 500, your returns are worse. So when you go all in on one stock, you need it to perform well in order to grow your money over time. So you are taking more risk, you can make more money, but at the same time, are you okay with that? To summarize, diversification is just a way to mitigate risk. So whether you're a category 1, 2, or 3 investor, there's no right or wrong answer. It's up to you and your personal goals to decide how much risk you want to take and what is your objective when it comes to finances. Once you answer that, you can use diversification as much as you want, as little as you want, it doesn't matter. But now you know, as a newer investor, it's out there, there's different choices, and you know how diversification can affect your overall returns. Thanks guys for watching, and if you did enjoy this video, consider giving it a thumbs up and subscribing to Main Street Wolf. Thanks again, and have a great day.